Hello, welcome back. What you are seeing here is our stock analysis tool running on an online server. So it's not running locally anymore, and you can kind of see how it behaves online. Because very soon I'm gonna be telling you how to get access to this tool. Probably in a few days actually, because everything seems to be running smoothly here. As you will see, all the modules are pretty much set. This is actually looking pretty fast as well. As you see, things are loading fairly fast here. And yeah, I like what I'm seeing so far. And I was examining some things here. It seems to be running fairly well. Now in this video, we are gonna be taking a look at Salesforce, and we're gonna do it live. So you'll see how that behaves. You'll see that I type Salesforce here, and I'm getting CRM Salesforce, and I click on it, and it's fetching market data. And you're actually now seeing how much time it takes. It's actually very quick, and it grabs all sorts of information. It does the whole analysis automatically here and starts with presenting you the numbers over here. And we can examine the company as a whole. It's pretty neat. Before we take a little bit of a look at the stock analysis tool, let's first take a look at the stock news. And yeah, again, this loads very fast. I'd love to see that. And yeah, there's some generic stuff being mentioned here, like versus news, Salesforce versus ServiceNow, and all that jazz. The next thing that I'm currently working on right now is actually adding a new module that's going to tell you target prices, so price estimates for the upcoming quarters, which is something that I really wanted to add. I actually have a lot in mind to add in this tool, and so if people start using it and they like it, I will keep adding stuff. And yeah, I want to make it better and better, sort of like the go-to tool for analysis. There's a lot of things that I want to be adding here, so it's going to be nice. But for now, let's take a look at what's going on here. What about the social trends? Not much happening right now. Now, these social trends get updated by minute, and so they kind of reset every hour. So this is actually on the hour, so this is why it has so little here. But it's expected to be growing as time passes. Or maybe there's just not enough activity yet. So I go back to the stock analysis tool, and let's examine what's going on with the company, because that's what matters. It's down 40% from its highs, $190 right now. And if we take a look at the max chart, which I always like to take a look at, it's a company that's actually heading higher, and it has its slump, the slump that a lot of stocks are having right now in the markets. Very usual for the markets right now. Now, what's going on in terms of the financials? The P ratio of the company is sitting at 128, which is very high, obviously. It used to be almost 1,000 plus here, which is absolutely insane, meaning that the company stock price was much elevated. It's a little bit better now, but still pretty elevated. Now, the price to free cash flow ratio, though, is better. So it means that while the earnings ratio, basically the price to earnings ratio, is a little bit elevated, the more important price to free cash flow ratio is elevated, but not that much. And so in this case, we do definitely have to examine what's going on with the company's financials, and the financial statements basically is what we're going to be looking at. And the next one is another X here, which is a massive increase in outstanding shares. And this is something that, if you have been watching the channel, you know that I hate, because it dilutes investors. And so if you bought here, it means that you got massively diluted, 38% more shares right now. And if you own 40% less of the business, pretty much, is what's going on here. So that's really bad to see. The free cash flow to total liabilities, it would take about 7 years of last year's free cash flow to pay back all the total liabilities. That's fair. It's not great. It's not terrible. The 5-year revenue growth, this is a company that grows and has been growing pretty nicely. I like to see that. The net income growth, even better here, and the cash flow growth also growing pretty nicely. Net income being the star, it looks like here, although there is a massive decline in 2022. 5-year total equity growth also increasing over here again, but they have been selling a lot of stock, so you have to bear that in mind. They probably got quite some assets from the outstanding shares that they actually sold and brought into the market. Debt to equity ratio is very low, much less than 1, which is great, and current ratio is 1.05, which is okay. I mean, typically this one is gonna be giving you a green here if it's 1.2 and plus, but 1.05 is acceptable for sure. Low return on equity here, and a low return on capital employed and invested capital. That's a little bit of a concern potentially. And let's take a little bit of a closer look now, because I want to see what's going on with the company's revenues and free cash flow and all that jazz. Now the company has been increasing its revenues very nicely, as you'll see here, pretty much achieving the same or very similar revenue growth every year. So that's awesome to see. And what about their net income? Net income here it has been increasing as well from 125 million to 1.44 billion. So the company has been increasing its revenue, their net income actually substantially, although it has dropped from the previous year. Okay, the balance sheet of the company, we will see here that total liabilities and total assets. So much less total liabilities than assets. That's of course good. But look at the additional paid in capital. They have sold a lot of stock, billions in stock. So they have funded themselves through that quite some. And that's important to notice. They have gotten a lot of equity because of that. Now the cash flow statement, because we want to see how sustainable the company is in terms of what they are doing in terms of their profit. Now they do make profit, as we already examined, but what about free cash flow? Because free cash flow is operating activities minus capital expenditures, is the purest form you can get pretty much, and cannot be manipulated that easily. It can, but not that easily. You do have to bear in mind that stock-based compensation and depreciation and amortization is added back to the cash flow statement, and it's a net income expense. It's an income statement, I wanted to say expense, and then it's added back to the cash flow statement because it's not a cash expense, and this is why it's added back here. This does skew our net cash provided by operating activities, as you can see though, because it's pretty much these values. It's the values that are actually added back from the income statement is what you're seeing here. So you have to bear that in mind. Now, of course, again, this is balanced out with the income statement, so it's not like we're having some sort of fraud here. This is normal, very normal, but you have to realize how it works, and that really helps to see how profitable the company is and how they are spending their money really, because this is an expense. Now, the net income used for the net cash used for investing activities is much in the negative here, because they seem to be investing quite some, but also selling a lot of maturities. Look at this. They have been selling a lot. They also bought quite some, but they're mostly a net seller here, and they have some other investing activities here reported, and a little bit of capital expenditure that seems to be kind of low here. So that's good to see. The financing activities is positive here, because they have been getting debt, is what this means. So they have been getting quite some debt. Although we examine their debt levels, they don't look that high based on the ratios that we saw already. So I wouldn't be too worried about this one. But the free cash flow is increasing as well to 2.2, 2.8, 3.6, 4, 5.2. So that's good to see. But what we really want to see here is our stock evaluation tool, and how the stock acts in terms of its price. How much we should be buying it for, and what is a fair price to pay for it today. Revenue growth is about the same every year, which is great to see. Now, I don't know how sustainable that is. Of course, I cannot go that high, but I will go high also for my high estimates, because the company is achieving that. So maybe it's possible that they do something of that sort. So I'm gonna go. Let's go 10, 15, and 20. This is relatively high, especially the last one. The first one is fine. The medium and high ones are a little bit high, especially this high one, 20%. But they could achieve it again based on what they are doing. So we can try that and see where that gets us at least. The net income margin here is fairly low. The average is 6.98, so we can always use this here if we wanted to, like 7, and then go maybe 5. Actually, let's go 5, 7, and 8 for this one. And the free cash flow margin. Again, this one is, as you'll see here, is very skewed, because we had some years of massive free cash flow, but not a lot of net income. This again gets skewed because of the stock-based compensation and the depreciation and amortization, and this is why I am using this kind of free cash flow margin when it gets compared to net income, because I want to extract free cash flow from profitability, from the profitability of the company, not because it's skewed towards free cash flow based on stock-based compensation and depreciation and amortization. This really helps bring down the numbers to normal levels here and normalize what I'm expecting from the company. And I do expect something of that sort here. This is more typical, way more typical, like 100% here for the company. So I'm gonna go, let's just say 100, 110, and 120. Let's just be a little bit optimistic here. And an annual return is that I want to get of about 13% is what I typically want to see here. So let's hit calculate and see what we're getting out of this. And you'll see that we are getting fairly low prices compared to the current price of the stock, which is 190, is very elevated. And so we're getting a high of 77.84 here is what we would be willing to pay for the company for our high estimates again. This points to a company that is overvalued. We have kind of already established this one, and this was kind of self-explanatory even by taking a look at the stock analysis here, because we did get a massive PE, as you remember here, a massive PE and a massive price. Actually, the price to free cash flow ratio is a little bit better, but we know why it's better. It's because of the depreciation and amortization and the stock-based compensation added back here, so this skews the free cash flow upwards. And so this is why it pays to use both of these, but using this kind of numbers, you can kind of already gauge that we're gonna be looking at a potentially overvalued stock. And when we do our analysis, we do in fact see that going on. So I hope you enjoyed the video and it helped you a little bit. You got a first glimpse of how the application is looking like and how it operates on an actual server. It's pretty much the first video that I'm making with the application actually running on an actual server and not my personal computer locally. And so yeah, this one is looking exciting, and I'm really stoked for taking this to you very soon. It's almost ready, as I mentioned, and in the upcoming videos I will for sure let you know how to get this one and how to become a member. So thank you for watching this one. Remember to like the video, that really helps, and tell me what you think about Salesforce, whether you are buying or not, what are you waiting, and what you think about the company. And if you're not a subscriber, remember to subscribe, because again, very soon I will let you know how to access all this here and all the new modules that I'm working on. There's gonna be a lot more added here. So thank you for watching again, and I'll see you in the next video. Bye bye.